Imagine opening your front door one morning and finding an official-looking envelope from HMRC waiting on the doormat. At first, it seems routine. Perhaps it's just another tax notice. Maybe it's something you can deal with later. But as you read through the letter, you realize HMRC wants more information about your finances. For many people, that's the moment panic sets in. The surprising part is that these inquiries don't always begin because someone deliberately tried to avoid paying tax. In many cases, they begin because something in the records simply doesn't add up. Before we go any further, take a second to like this video and subscribe. We bring you clear, practical updates on UK pensions, banking, tax, savings, and personal finance, helping you stay informed and avoid expensive mistakes. Now here's something that catches thousands of people by surprise. HMRC has access to far more financial information than most people realize. That doesn't mean someone is watching your bank account every day, nor does it mean every transaction automatically triggers an investigation. But HMRC receives information from many legitimate sources to help identify situations where tax records may need a closer look. That's why keeping accurate records has never been more important. Let's start with the first warning sign: a mismatch between your declared income and your overall financial picture. Imagine two people earning exactly the same amount. Both report similar incomes, but one appears to purchase expensive vehicles, investment properties, and luxury holidays while declaring relatively modest taxable earnings year after year. Does that automatically mean they've done something wrong? Of course not. Perhaps they received an inheritance. Perhaps their partner earns significantly more. Perhaps they sold a property. There could be dozens of perfectly legitimate explanations. The issue isn't necessarily the lifestyle itself. It's whether the available records clearly explain how it was funded. When the financial story makes sense, questions are usually answered quickly. When it doesn't, further inquiries can become more likely. That's why documentation matters so much. If you receive a significant gift from family, keep a record. If you inherit money, retain the solicitor's paperwork. If you sell an asset, keep the sale agreement. Those documents don't just protect you today. They protect you years later when memories have faded. Now let's move to another common area where people unintentionally create problems: mixing business and personal finances. This happens far more often than most people realize. Someone runs a small business. Customer payments arrive into a personal account. Household bills are paid from business income. Business expenses are covered using personal savings. Everything works until someone later tries to understand which transaction relates to what. Suddenly, untangling months or even years of financial activity becomes incredibly difficult. That's why accountants regularly recommend keeping business and personal banking completely separate whenever possible. One account for business, one account for personal spending. Simple, clear, easy to follow. That straightforward separation often answers questions before they're ever asked. There's another area that catches many self-employed people off guard: expenses. Everyone wants to claim legitimate business costs. That's perfectly reasonable. The tax system allows businesses to deduct qualifying expenses. The challenge is understanding what genuinely qualifies. Some purchases clearly relate to work, tools, equipment, professional insurance, business software. Those are usually straightforward. Other expenses fall into much grayer areas: meals, subscriptions, vehicles, home working costs. The question isn't whether something was useful. The question is whether it genuinely qualifies under the relevant tax rules. That's why relying on guesswork can become expensive. If you're ever unsure whether an expense should be claimed, seeking professional advice before submitting your return is almost always cheaper than correcting mistakes later. Now, here's another situation that's becoming increasingly common: online selling. Years ago, someone might have sold a few unwanted household items without giving it another thought. Today, online marketplaces have transformed the way millions of people buy and sell goods. Some people occasionally clear out wardrobes. Others buy items specifically to resell for profit. Those are very different activities. Selling personal belongings you already own isn't necessarily the same as operating a trading business. But once buying and selling becomes regular with the intention of making profit, different tax considerations may apply. That's why understanding the difference matters. Not because every online seller owes tax, but because assuming the rules never apply can create unnecessary complications later. If you're earning money through online platforms, keeping accurate records of sales, purchases, and expenses makes life much easier, should questions ever arise. Let's also talk about something many people underestimate: cash. There's nothing unlawful about accepting or using cash. Millions of legitimate cash transactions take place every day across the UK. However, businesses handling large amounts of cash often need particularly good record keeping because cash transactions naturally leave fewer automatic records than electronic payments. Imagine a cafe, a barber, a market stall, a taxi driver. Each receives cash regularly. The key isn't avoiding cash. The key is making sure every legitimate sale is accurately recorded. Because when business records consistently match sales, stock, invoices, and banking activity, they tell a coherent financial story. Good bookkeeping isn't just about satisfying HMRC. It's about protecting yourself. When records are complete, clear, and organized, answering questions becomes much easier. And perhaps that's the biggest lesson from everything we've discussed so far. Most financial difficulties don't begin with dramatic fraud investigations. They begin with small gaps, missing paperwork, poor organization, forgotten records, assumptions, tiny issues that gradually become much larger because nobody dealt with them while they were still easy to fix. The good news is that almost all of these situations are preventable, not through complicated tax planning, not through expensive software, but through consistent, organized financial habits that make your records tell a clear, accurate story from the very beginning. There's one mistake that often costs people far more than they ever expected, not because it's illegal, not because they intended to do anything wrong, but because they assumed they could deal with it later. Deadlines. If there's one thing HMRC consistently takes seriously, it's time. Many people think the biggest problem is not having enough money to pay a tax bill. Surprisingly, that's often not the case. Missing the filing deadline can create problems even before payment becomes an issue. Think about it. If you know you can't pay everything immediately, you might be tempted to avoid submitting the return altogether. That feels logical. But in practice, it's usually the opposite of what you should do. Submitting your return on time shows you've met your reporting responsibility. Payment arrangements can often be discussed separately if necessary. Ignoring both simply allows penalties and interest to build while nothing gets resolved. That's why many accountants repeat the same advice every year. File first, deal with payment second. Now let's move on to another area that quietly catches thousands of small business owners, VAT. Many people only think about VAT once they're already close to the registration threshold, but by then, decisions made months earlier may already matter. Business income doesn't always increase in neat, predictable steps. Some months are busy, others are quiet. That's perfectly normal. What's important is understanding your turnover throughout the year rather than checking it once at year end. Waiting until it's too late can create unnecessary complications. If your business is growing steadily, reviewing your position regularly gives you far more flexibility than trying to solve everything after crossing an important threshold. Professional advice at the right moment often prevents expensive mistakes later. Now let's talk about something that rarely gets discussed. Consistency. Financial records tell stories. When those stories remain consistent year after year, they become much easier to understand. Suddenly changing accounting methods, mixing personal and business spending, changing the way income is recorded without explanation. These situations don't automatically mean anything is wrong, but they often create questions that could have been avoided. Imagine reading two versions of the same story. One follows a clear timeline. The other jumps backwards and forwards with missing pages. Which one would be easier to understand? That's exactly how organized financial records work. They provide a complete picture without forcing anyone to guess what happened. Another habit worth developing is reviewing your records before submitting anything. Don't rush. Take another look. Check your figures, compare them with previous years. Do the numbers make sense? Are significant changes supported by documentation? Sometimes 5 minutes of careful checking catches mistakes that could otherwise take months to correct. Now let's address something that worries many people. Receiving a letter from HMRC. The moment that envelope arrives, it's easy to assume the worst. But remember this, an inquiry isn't automatically an accusation. Sometimes HMRC simply needs clarification. Sometimes information doesn't match records already available. Sometimes they need supporting documents. The way you respond often makes a significant difference. Panic rarely helps. Sending incomplete information usually creates more questions. Guessing answers from memory can unintentionally create inconsistencies. Instead, slow down. Read the letter carefully. Understand exactly what's being requested. Gather the relevant documents. If necessary, seek professional advice before responding. A calm, organized response almost always places you in a stronger position than reacting emotionally. Let's also talk about digital record keeping. Years ago, businesses relied almost entirely on paper files. Today, many records exist electronically. Bank statements, invoices, receipts, payment confirmations, accounting software. The advantage is obvious. Documents become easier to search, harder to lose, simpler to organize. Even if you still prefer paper records, creating digital copies of important documents provides valuable protection. Computers fail, paper fades, accidents happen. Having a secure backup can save enormous frustration later. Now think about this for a moment. Suppose someone asks you about a financial transaction from 4 years ago. Would you rather rely on memory or open a folder containing the invoice, bank statement, receipt, and confirmation within seconds? That's the difference good record keeping makes. It removes uncertainty, it replaces guessing with facts, and that's incredibly valuable whenever financial questions arise. Perhaps the biggest misunderstanding surrounding HMRC is believing investigations appear without warning. In reality, many problems begin much earlier. Small bookkeeping mistakes, late paperwork, missing records, incorrect assumptions. None of these seem particularly serious on their own, but over time they accumulate. Eventually, one issue leads someone to ask another question, then another. That's why staying organized isn't just about today's tax return. It's about making next year's easier, and the year after that. Good habits compound, the same way poor habits do. So before we finish, here's one practical exercise that could save you considerable time in the future. Create one folder called Important Tax Records. Asterisk, asterisk. Every time something significant happens financially, place four things inside. First, a short note explaining what happened. Second, the supporting documents. Third, the relevant bank statement. Fourth, any correspondence connected to the transaction. That's it. Nothing complicated, nothing expensive, just one organized place where important financial events are recorded. If nobody ever asks about them, excellent. If they do, you'll already have everything you need. Finally, remember this. Most people never hear from HMRC beyond routine correspondence. The overwhelming majority of taxpayers go about their lives without major problems. The best way to keep it that way is remarkably simple. Keep accurate records, meet important deadlines, separate personal and business finances where appropriate, claim only expenses you're confident you can support, and don't ignore small problems hoping they'll disappear by themselves. Because good financial organization isn't about avoiding HMRC. It's about giving yourself confidence that if questions ever arise, your records already provide the answers. If today's video helped you better understand how organized financial records can protect you, consider sharing it with someone who runs a business, works for themselves, rents out property, or manages their own tax affairs. A few simple habits adopted today could save someone significant stress tomorrow. And if you'd like more easy-to-understand updates on UK tax, banking, pensions, retirement, and personal finance, don't forget to subscribe and turn on notifications. Thank you for watching, take care, and I'll see you in the next video.